Long-term versus short-term divergence trading. Now, as far as the pattern is concerned, there's really no difference. We know the market's fractal in nature, so the same patterns that we see on the weekly chart, we're going to see on the 5-minute chart. All right, so there's no difference between how we use the patterns for long-term or short-term trading. There will be some obvious differences in the things we need to consider, however. All right, so short-term trading is obviously going to be more susceptible to intraday market volatility. Maybe we have worse or better than expected micro or macro data come out. There's volatile geopolitical events taking place. We have a central bank come out with unexpected comments or an unexpected rate change, something like that. Obviously, that's going to have more of an impact on the short-term trade. And if you're trading longer-term divergence, say you're looking from the weekly or the monthly charts, then obviously this is going to be best done in line with your overall fundamental assessment of the economic conditions surrounding the currency you're trading. So at that point, you want to maybe also have a look at some of the fundamentals. How's the overall health of the economy? Look at bond spreads between the currencies that you're trading and things like that. All right, so those are just things we want to consider. Now, obviously, we approach the market from a much more technical perspective. So when I say you want to you want to have a good understanding of these things that are taking place, but you don't have to become an economist to trade long-term divergence, okay? Because the patterns in the market pretty much show the fundamental picture is pretty much built in, if that makes sense. It's pretty much built into the patterns that we see. But you want to know if there's any potential large fundamental changes that could be coming up. Okay, that could change, like we talked about earlier, change the market routine, change the market's habits. Okay, also a benefit of trading longer term or higher time frame charts, since we will often use smaller degree time frames for entry into the longer term positions, there will be more opportunity to lock in good profits even if the pattern has not completely unfolded. So trade management will work a bit differently with the better reward to risk ratios. For the most part, with the short-term trades, when you're trading divergent setups the way we're going to teach you to trade them, for the most part, the most common way we trade divergence, you're going to have about a 2-to-1, maybe a little bit less, between 1.5 and 2-to-1 reward to risk ratio, depending on what retracement level you look to enter into the market. If you use the 50 or the 62, obviously you'll have a better reward to risk if you use the 79%. While at the same time, you're going to have less trades. But if we're using an hourly chart and we have a divergence setup or an extension setup on an hourly chart that we use to enter into a weekly setup, right? Obviously, you're going to have a much better reward to risk. You're putting your stop above that hourly pattern and you're targeting that weekly target. Okay, so you're going to want to lock in some profits if price does start to move significantly in your favor. You could very easily get up 2, 3, 4, 5% and still have a ways to go for that trade. Okay, and if you're getting those kind of percentages up in the market, you obviously want to start to lock some of that in, start protecting some of those profits. Okay, otherwise there's really no difference between the patterns for long-term and short-term. It's really more with the trade management and the things that we want to consider while we're looking to place the trades. So intraday, obviously, we want to focus on the micro and macro events that could be coming up for that day, okay, or that week. And for the longer term, we want to focus on the bigger economic picture.